Every morning, people post screenshots of massive profits, and just a few hours later, those same people are panic refreshing their portfolios. That is the stock market, a place where emotions change every second. But in the middle of all this chaos, one man taught the world to stop treating the market like a casino and start treating it like a business. His name was Benjamin Graham, and his philosophy transformed investors like Warren Buffett forever. Today, we're breaking down the system that helped millions of investors escape the emotional traps of the market, and maybe it will change the way you think about investing forever. Welcome to BookPrimeXGlobal. Today we decode Benjamin Graham's legendary value investing philosophy. But here's the warning. If you're looking for shortcuts to get rich fast, this video is not for you. Because Graham's system is slow, boring, but dangerously effective. Most people in the market see stocks as nothing more than numbers. Green? They feel excited. Red? They panic. But for Graham, a stock was never just a moving chart. It was a real business. When you buy a stock, you're not buying a ticker symbol inside an app. You're buying a small piece of a company. And that mindset alone separates the average trader from the intelligent investor. An intelligent investor always asks, what does this company actually do? Are its products strong? Is the revenue stable? How much debt does it carry? Can it grow in the future? And most importantly, am I paying too much for this business? Because buying a great company is not enough. Even a great company can become a terrible investment if bought at the wrong price. Now let's meet the most dangerous character in this story, Mr. Market. Benjamin Graham described the stock market as an imaginary person whose mood changes every single day. Sometimes he becomes wildly optimistic and pushes prices insanely high. Other times, fear completely destroys him and he starts selling great businesses for almost nothing. And here's the problem. Most people let Mr. Market control their emotions. When the market rises, they buy out of greed. When the market crashes, they sell out of fear. But the intelligent investor doesn't follow Mr. Market. They observe him, use him, and take advantage of his emotional swings. That is the difference between investing and gambling. Now we arrive at Benjamin Graham's most powerful concept, margin of safety. Imagine a company is truly worth $100, but because of panic in the market, its stock is trading at only $60. That $40 difference becomes your protection, your safety cushion. Because the market is unpredictable, your calculations can be wrong, the economy can change, unexpected events can happen. But when you buy a stock at a discount, your chances of surviving mistakes become much higher. And in investing, survival matters more than profit. Because the people who win in the market are usually the ones who stay in the game the longest. Cheap stock versus value stock. This is where most investors make dangerous mistakes. They confuse cheap stocks with value stocks. Not every low-priced stock is a good opportunity. Some companies are cheap for a reason. Weak business, no growth, no future, no stability. But a true value stock is a strong business temporarily selling at a discount because of fear. The difference looks small, but over decades, that difference creates massive wealth. Two types of investors. Benjamin Graham divided investors into two categories. First, the defensive investor. Someone who wants safe, stress-free, long-term investing. Lower risk, less activity, more consistency. Second, the enterprising investor. Someone willing to research deeply, find undervalued businesses, and actively hunt for opportunities. And here's the interesting part. Neither approach is wrong. The real question is, which one matches your personality? Let's talk about practical rules. If you want to survive in the market long term, these habits matter. Never blindly trust market tips. Always check a company's debt. Focus on businesses with stable profits. Don't buy stocks just because prices are falling. Maintain a margin of safety. And most importantly, understand your own emotions. Because in the stock market, the biggest enemy usually isn't the market itself. Sometimes it's your own impatience. Benjamin Graham didn't define investing through complicated formulas. He defined it through discipline. His system may not feel exciting, but even decades later, it still works. Because markets can change, technology can change, entire industries can change, but human emotions, fear, greed, panic, excitement, never truly change. And maybe that's why value investing remains relevant even today. So now the question is your investing strategy designed only for the next month or for the next 20 years? If you found this video valuable, subscribe to BookPrimeXGlobal, because here we don't just summarize books, we decode them into real-life perspective.